Hello and welcome to this webinar on guessing market direction with option chain. Please note that this is not a webinar on how to use the option chain or a demo of the option chain or the underlying theory of option chain. We'll just focus on one thing in this entire webinar, which is guessing the market direction, which I believe is also the most important. I mean, what are we all here for, right? So let's go right into an option chain. So this webinar will cover how to guess direction using open interest analysis. We'll briefly touch upon put call ratio again from a point of view of guessing direction purely. We'll talk about max Payne, and we'll do all of this on Sensible's free option chain. Let's move on. So this is what an option chain looks like. This is what our option chain looks like, and we'll focus exclusively and almost entirely on these two things, which is all these green bars which you see here and all these red bars which you see here with these numbers. We'll ignore everything else. We'll ignore everything else like Greeks, IV, a bunch of other things, because they don't really have any predictive power when it comes to market. And let's face it, right, they're just too technical, and the return on investment of your time in terms of guessing market direction in it could be very low. So let's get to the basics. So the most important thing in an option chain is open interest, also known as OI. It is the number of call or put contracts at a strike. So to give you an example, if I take this option chain, which is today's live Nifty option chain, a 12,000 strike call has an OI of 31.5 lakh contracts. 11,900 strike call has an OI of 24.5 lakh contracts. 11,700 put has 24.4 lakh contracts, and 11,600 put has an OI or an open interest of 16.3 lakh contracts. So if I ask you the question, what is the OI of 12,000 call, you'll say that it's 31.5 lakh contracts, right? So here's the most important part. A high call OI above the current price means that there is a resistance there. So what do I mean by a resistance? It means that it is unlikely to go above that number. So you can see 12,000 has like a lot of calls here. It means that it is unlikely to go above 12,000, right? I'll explain why this is, but this is the most important part. A high put OI below the current price usually means a support. What does support mean? It is unlikely to go below that level. So in this example, Nifty is at around 11,700. The put open interest is at around 11,700. So Nifty is unlikely to break 11,700. And if you have been following the market the last 1 or 2 weeks, this has been the story of the market. It has been crashing down from 12,000 and bouncing up from 11,700. Okay, let's move on. So if there is huge OI in 2 or more close call strikes, like you can see it here, right? 11,900, 12,000, they have reasonably high OI and they are close enough, and this acts as a zone of resistance, right? It's not like 12,000 exactly is the resistance. It could be that 11,900 to 12,000 zone is a resistance. And similarly, when it comes to puts, there is support at 11,700, some support at 11,800, so it kind of acts as a zone, right? This is a zone, this is a zone. So here's the most important takeaway, right? So now purely using option chain, you have found supports and resistances. Supports the point from which you can initiate long trades on Nifty. Resistance is the point from which you can initiate short trades on Nifty. So again, this is not the full picture. Open interest analysis on an option chain is a very important part of determining direction, but don't go only purely based on that. If you have an extra thing like a price action or volume or pure technical chart, this is a very important confirmation of whatever you have derived from that. And even otherwise, standalone, this has a lot of value, but it's always better to combine technical signals, right? So let's explore more. The most important thing to understand here is it does not work all the time on all the stocks. There are a very few select stocks on which it works and some situations in which this works. So if you use this open interest analysis incorrectly, it can land you in a lot of trouble. So the most important thing is that this open interest has to be a big number, right? So let me give you an example, right? So if you say that India's GDP grew 7%, that number has significance because GDP itself is a 7% number. I mean, it's a huge number, right? A huge GDP number growing 7% it means something. Whereas if I were to say Sierra Leone's GDP, right? I'm not even sure half the people have even heard of Sierra Leone. It's a country in Africa. So Sierra Leone's GDP growing 20% does not mean anything, because Sierra Leone might not have a good GDP. So the open interest has to be significant for it to be of any importance. It has to be a big number. And which kind of contracts have big open interest numbers? Nifty and Bank Nifty weekly options have it. Nifty monthly options have it, but not at like the beginning of. So it's like if the monthly expiry is on 29th, you can't expect OI to be significant on 1st of that month, right? You have to wait till probably 10th or 15th, because the OI has to be formed after some trading. It is true for heavily traded liquid stock, and it does not work well, and that happens when OI is not a big number. So for example, far away expiries, if you look at, so this is October, if you look at Nifty December, it might not have significant OI, or Nifty Jan might not have significant OI. Smaller stocks with low market cap, I mean all these smaller stocks, right? Like there are so many of these stocks which are outside Nifty 50, which are not heavily traded. They might not have a lot of OI. Illiquid stocks or options, again a variant of whatever I told you right now. So there are some stocks which might be big, but their option chain is simply not traded much. These are also not very good candidates for that. So if I were you, I would stick to the top 20 odd stocks. I mean, it doesn't even matter, because most of the trading is happening in Nifty. So if you are a Nifty or Bank Nifty trader, as long as you stick to Nifty weekly, Bank Nifty weekly and Nifty monthly, you're pretty much good. You don't need to do or think about anything else. Also, one significant thing, it's not a great idea to base your decisions purely on open interest analysis when there are events, right? Especially stock results and all. I've seen it like a couple of times that Reliance, for example, had huge call open interest build up before a result, and it broke like a 5% mark to the upside the next day. So events, not a good time to base your trades on open interest. And again, always use this along with something else like volume or price action. It doesn't mean that option chain is not important enough. It is, but always when you are doing trading decisions based on technicals or price action, it's always good to combine more than one sources of information, right? So let's take some examples. So let's just try to interpret some option chains. So this is Nifty option chain. So before that, you can just quickly take a look at what all can you do on this option chain. You can see Nifty here. This is ATM IV, at the money strikes IV. There is an IV chart. There's an analysis of the open interest. There's a toggle which tells you prices per lot multiplied by 75 or not. You can select expiry here. This demo video which we are making will go right here. These are calls, these are puts, and there are some interesting settings here. So you can see all strikes or hundreds only strikes, because in Nifty, right, the hundreds are the more important strikes. You can turn off Greeks, turn on Greeks. You can turn on volume or turn off volume. I mean, there are three settings for, depending on what kind of font size you like. It's a very improved option chain, and it's pretty nice, something which we are incredibly happy that we did. And you can change the number of strikes you want to see. So let's look at what it means. Oh, so there's one more nice addition which we done. So this is a liquidity indicator. So it tells you whether this option has been traded or not, and if it is illiquid, you know what to do. You have to stay away from that option. So moving on. So look at Nifty's option chain, right? You can see a lot of puts in this zone. Let me just increase the font a little bit. You can see a lot of puts in this zone, and you can see a lot of calls in this zone. So purely based on this, I would say Nifty is likely to be in this range. Let's say 11,700 to 12,000 range. We'll see what happens. I mean, things always change, but as of now, that looks like the story. There's a lot of puts getting added in these strikes which are below. But the important part to also understand is that all these puts are seeing a significant jump percentage wise in the number of contracts. So 11,500 put increased 30%, 11,600 increased 22%, 11,700 increased 25%, 11,800 increased 122%, 11,900 increased 100%. So it's a lot of strong bullish activity here, right? Whereas if you look at the call side, it's not so much. 12,000 call only increased some 6%, 12,100 increased some 24%. So based on this, there's resistance here, there's support here, but there's a lot of bullish momentum here, right? So let's look at some other option chain, Nifty monthly. So we'll just change the expiry here. Roughly the same story. There's a lot of support emerging here, there's a lot of resistance here. You won't see the kind of numbers changing 30-20% in Nifty monthly like we saw in Nifty weekly, because monthly is not as heavily traded as weekly, because face it, right, everyone likes to gamble weekly. So so let's look at Bank Nifty now. So the most interesting thing about Bank Nifty is that almost all the activity happens at the 500 strikes when you take a monthly. Even if you take a weekly strike, there's a lot more action at strikes which are ending or are multiples of 500 compared to the other strike. So 24,000 is a zone of support. 23,500 has some sort of open interest build up on the puts. 23,000 has some open interest build up, but this is inconclusive, right? Because I can see that there are some contracts here, there are some contracts here. Probably the biggest contract is that 24,500. 25,000 has a lot of call options. So this is like a sort of inconclusive option chain. There's nothing much here, except probably I might think that 23,500 and 25,000 seems like a range, right? So there is a shortcut in case you want to know which one is more, calls or put. It's called PCR, put to call ratio. So if you look at PCR here, it's 1.15. It means there are more puts than calls. So we'll come to that in detail later, but that's inside this info button. So coming back to it, let's look at another example, Infi, and see how it has worked out, right? So let me change the stock to Infi. So this is Infi. Now here's the interesting part, right? 12,000 has a lot of calls, and 12,000 seems like a very big resistance. Now let's see if that is true. Let's look at the chart of Infi. You can see this, right? Infi went to nearly 12,000 and just crashed from there. So this was the high around 11.55 and it crashed from there. So there is some value which you can make out of the option chain here, which is the 12,000 is likely to be a resistance. Of course this is post facto because it has happened in the past, and but you can see this here, right? Look at this huge red candle when it went near to 12,000, right? So 12,000 we can say is a zone of resistance. Not much in terms of support emerging anywhere. 1150 is also got huge open interest at 32.5 lakh contracts. Now let's look at another one, HDFC Bank. This is pretty interesting. There are a lot of calls, there are some amount of puts. So this seems more bearish than bullish, purely judging by the option chain. And let's look at that other number, right? Info, PCR. PCR is like half, which means that the number of puts are twice the number of calls, which you can see clearly here. So purely based on this, HDFC Bank doesn't look good, but you can see that today it has went up over 1%, right? So again, this is purely not conclusive, but it is a very valuable insight provider to price action. Now let's look at HDFC. So HDFC again has a lot of calls here, some puts here. So it's like an even Steven kind of an option chain. Now let's look at an example of an option chain which does not really work, which is ICICI Pru Life. Now why did I say it doesn't work? Because it doesn't have significant open interest. So look at this, right? These are all small numbers, 1.8 lakh, 2 lakh, 1.8 lakh, 3 lakh contracts. Whereas if you compare it with, like, let's say a HD or ICICI Bank, for example, right? 20 lakh contracts, 35 lakh contracts, 30 lakh contracts. This 18 lakhs, 13 lakhs, 16 lakhs, they're all very significant big numbers. Whereas if you look at ICICI Pru Life, it's only some 1 or 2 lakhs, and that's not much, right? So it's not a very big company, it's not a heavily traded stock. I mean, it is a very big company, but compared to ICICI Bank, it's nothing. So it's not a very heavily traded stock, it's not a very heavily traded option either. So this is an example of a stock in which I probably will not take my decisions based on option chain alone. Similarly, if I look at Nifty, right, lot of open interest, 20 lakh, 18 lakh, all sorts of huge numbers here. Whereas if I take Nifty of, let's say, November, I can immediately say 1 lakh, 2 lakh, very less open interest, right? So this is an example of an option chain which is not fully formed yet, and this is not something I would want to trade on. So what trades can be done? If there is a significant call OI around a strike, you can sell calls of that zone. If there is a significant put OI around a strike, you can sell puts of that zone. If there is both, you can sell both and expect the market to be between these strikes. So the typical example of that is this week's Nifty. So if you look at it, this week, so that's 22nd October, it's between these two zones, and it's a solid strangle selling opportunity. Not saying that you should sell strangles based on this analysis, do your own research, etc, etc. So a lot of people ask us the question, why is call considered to be a resistance and put considered to be a support? So this is a never ending debate. Some people say that you shouldn't look at it that way, but largely, mostly, right, smart money and big institutions are most of the time option sellers. I'm not saying all the time, most of the time, right? And in trading, your entire idea is to get your decisions right most of the time, right? You can't get 100% accuracy. You can only be right, let's say 7 out of 10 times. So usually, if there is huge open interest at a call strike above, it means that someone big is selling the call. You know, they are saying that, look, I don't think this strike will be breached, therefore I am comfortable selling the call. The market won't go above that level, right? And usually if there is a huge open interest at a put strike below, someone big is selling the put. They are saying that, look, I don't think market is going to go below the strike, so I am comfortable selling the put. Like somebody is saying here that 12,000 won't be breached. Somebody is saying here that 11,700 won't be breached to the downside. So if you assume that these big institutions are likely to be right most of the time, then it's kind of obvious that, you know, we'll also do what they do. You know, we'll join them if we can't beat them. And if they are right, then it means that this option chain supports and resistances are actually based on, you know, call and put OI. Now let's look at an important thing, which is change in open interest. So we looked at, you know, open interest, which gives you a snapshot. Now we look at change in open interest, which tells us the momentum. So if calls are increasing at or above the current price, it is usually bearish. Why? Because people are selling the call, right? They are saying, look, it won't go up, I am happy selling calls. And if calls are decreasing at or above current price, it just means that somebody who has sold the calls are now getting out of that calls, right? It means that market is likely to go up, so people are just getting out of their sold call positions, which will make a loss if market goes up. If puts are increasing at or below a current price, it is usually bullish because people are selling puts. They are comfortable and confident selling puts. And puts are decreasing at or below current price, it is usually bearish. Why? Because people are getting out of sold puts. They are saying, boss, I don't want to be in this thing, I think I'll lose money if market goes down. So let's look at the example of Nifty, right? Here you can see that puts are increasing and it is a bullish signal, and you can see that today market has went up 1%. Now it's a different issue. Did puts increase because market go up, or did market go up because puts increase, right? But anyway, that's like a never ending debate. You could also see that But here's the interesting thing, right? It's not like calls are going down. They are also slowly increasing. So it's not an outright situation where there is unwinding at calls and people are getting out of calls. Of course, people have got out of 11,800 calls because 11,800 got breached this morning. So 11,800 has seen a decrease of around 10%. People went away. So like I said, right? If people are getting out of sold calls, which is this 11,800 for example, it means that people are getting out and they know that 11,800 has gone for a toss. 11,700 also saw a significant decrease in OI. People got out of 11,700 too. But not so much when it comes to these calls, which means there might still be resistance in these areas. But this definitely is a bullish signal. Look at this. This is huge increase across the board on all lower strikes. Now, let's look at something interesting before we move further. Just a quick preview. Did you know that you could do this and get the probability of ITM from our option chain? You could also set a WhatsApp alert from our option chain. This is bid offer and all usual standard stuff, nothing big. But an interesting thing is this in the money probability and setting WhatsApp alert on your options price in case you are watching that. Another interesting thing is that you could make basket orders from this option chain. So for example, let's say that you want to do a strangle, right? Let's say I'm selling this 11,700 and I'm selling this 12,100. So my basket order is ready right here. So I can change quantities here and trade directly from here. I could also analyze my trade before I do all that using our own builder. So here you can see how your PNL changes with the change in Nifty or the change in days. You could see your Greeks, IVs, a lot of data here. It's very useful if you're trying to really get into depths of your math. Okay, so let's move on and look at open interest analysis. So you can enter it from here or you can enter it from here. So let's try and enter it from here. So this gives you, this is the change in intraday OI. So this tells you today's action, and that is a lot of clue into today's price, today's movement, right? So look at this. Puts are increasing, calls have decreased here, some minor call addition here, but largely today's story is a bullish story, and you can see it here also 1% up Nifty. So this gives you a clue into the current momentum. So let's look at some past examples, right? So I can change it to intraday, and let's go for that day when there was a fall. Yeah, this was a fall when Nifty did around 300 point fall between 14th and 15th October, and let's see what happened on 15th October. So you can see it here. 14th October futures was trading at around almost 12,000, and the next day it was trading around 11,700, right? So on that day when Nifty fell 300 points, you can see calls increased by 10 million, puts decreased by 10 million. Why? Because people who sold calls were like, chalo, let's sell more because market is falling, and people who sold the puts were like, if I stay in this put, I'm going to be rogered, let me get out of this put. So they got out of the put and put OI decreased, right? And you can see it here, right? Put decrease, put decrease, put decrease, put decrease. All of this green bars towards the bottom, they are telling you that put has decreased and market is bearish. And you can also see how to interpret this here, and this is saying that, you know, calls are being sold and market is going to go down. You can fiddle around with this. There is enough tutorial information on this page itself. Okay, let's move on to the next one. Multistrike OI analysis. So this is again a feature which we made, which is here. So what does this tell you? It tells you today's action along with the most active strike. So you can see Nifty today it has been going up, and you can also see the most active put, which is the 22nd October 11,800 has been going up. So if puts are going up, it usually means that market is going to go up. So you can see it here, right? And you can create your own groups. You can, you know, it can be in any underlying. You can do it in Nifty, Bank Nifty, anything. So this tells you days action on a select few strikes along with Nifty graph for that day's price action. So you can change the time frame, you can have a total view or a change view. I strongly recommend the total view. So basically, how do I interpret it? Today, this is today, October 19th, 9:15. Market has gone up, so has puts. So if call OI increases through the day, market is bearish. If it decreases through the day, market is bullish. If the put OI decreases through the day, the market is bearish. If it increases through the day, the market is bullish, like this. So the put will always be in a shade of green. The call will always be in a shade of red. Why? Because calls are bad for market and puts are good for market, right? Okay. Now comes put call ratio. I'm pretty sure after having seen, so a lot of people ask us, is put call ratio is put on top or call on top? I'm pretty sure after seeing this extremely disturbing image of this bear and bull, you will never forget what is put call ratio. So put call ratio is number of puts divided by number of calls. A high PCR means it is bullish. Why? Because there are more puts than calls. It means that the big sellers are willing to sell puts more than calls. It means that they are saying the market won't go down much, right? And a low PCR is bearish, more calls than puts. Big sellers are willing to sell calls more than puts, which means that they are scared of market falling and not so much of rising, right? So let's take some examples here again. How do I see PCR? I can go to this info button and PCR is 0.93. Now this is so when I looked at it last Friday, the PCR was around 1. It was a bullish signal and today the market went up again. I can see, so usually, right, stick to PCR on the nearest coming expiry. If it's Nifty, stick to the current week or maybe next current month. If it's stocks, stick to only that month's PCR. There's also another place where you can see all PCRs together, which is our screener. So if you are looking for some extremely bullish stocks, you can see this here, right? It also gives you a breakdown of each expiry's PCR. So Bank Nifty has high PCR, Nifty has high PCR, HDFC has high PCR, and they are all stocks which has gone up, right? 2.6% up. Axis Bank has high PCR. IndusInd Bank has reasonably high PCR. Above 1 is a very definite high. 0.7 is where I say, it's neutral. So 1 is not neutral, 1 is bullish, 0.7 is neutral, below 0.5 is what I'll call bearish. And anything between 0.5 and 1, it's not very clear. Let's wait and watch is the usual approach. So now let's go to Max Payne. So Max Payne, before we get into this, right, it's just a theory, okay? Half the academics I've met denounce Max Payne. They say it doesn't really work. So the idea is this. Max Payne theory says, and I'm going to use the word Max Payne theory because there's no proof. I have seen so many people overblowing Max Payne, making like different versions of Max Payne, saying it works, etc. I'm still not sure how much this works. Of course, there is some common sense aspect to the Max Payne theory, but trading based on Max Payne and saying that, look, Max Payne is 11,800, therefore expiry is at 11,800, I'm not sure if it works. So expiry happens at a strike which causes least damage to the sellers. This is what Max Payne theory says. Again, not considered to be super scientific, but then again, the academics say that even technical analysis doesn't work, right? So the point at which the sellers will have the least loss is considered to be the Max Payne point, and Max Payne theory says that the expiry of a stock will happen at that particular level. So let's see, right? So let's go to option chain. So I don't know what is Max Payne, so let me see what is Max Payne. Max Payne says it is 11,800. So the theory says that this week's Nifty expiry will happen around 11,800 because that is where sellers will have the least amount of losses. also seems to be correct, right? The put sellers will have the least loss, call sellers will have the least loss if expiry happens somewhere in the middle of this, right? So that is the Max Payne theory. So this actually brings us to the end of our session on how to guess market direction with option chain. Thank you so much for joining.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
5 पैसा के प्रोडक्ट्स और सर्विसेज के बारे में ज़्यादा जानकारी के लिए और लेटेस्ट अपडेट्स के लिए हमारे YouTube चैनल को सब्सक्राइब कीजिए। 5 पैसा के साथ निवेश और ट्रेडिंग की शुरुआत करने के लिए 5 पैसा मोबाइल ऐप डाउनलोड कीजिए।